Did you know that as of 2023, there are over 300 dividend-focused ETFs on the market? That's a whole lot of dividends. But hold up a second. Before we dive into dividends, let's take a step back and understand what an ETF is. ETF stands for Exchange Traded Fund. Think of it as a basket of various stocks, bonds, or commodities that you can buy or sell on a stock exchange, just like you would with individual stocks. Now imagine an ETF that's specifically designed to focus on companies that pay dividends. That's a dividend-focused ETF for you folks. These ETFs are popular because they offer a way for investors to earn regular income in the form of dividends, in addition to potential capital gains. It's like having your cake and eating it too. So if you're interested in a hands-off approach to income generation, stay tuned. We've got some tips for you. First things first, you need to understand the power of dividends. Picture this. You're the owner of a bustling lemonade stand. At the end of each day you count your earnings and find you've made a tidy little profit. This profit represents your dividends. Just replace the lemonade stand with a company, and you've grasped the essence of dividends. They're portions of a company's earnings, paid out to shareholders. That's you if you own stock in the company. Now why are dividends the bee's knees in the investment world? Well, there are several reasons. First, they provide a steady stream of income, separate from the ups and downs of the stock market. Think of it as a comforting cup of tea amid the roller coaster ride of stock prices. Second, dividends are a sign of a company's financial health. If a company can afford to pay dividends, it's a good indication that they're doing well. It's like getting a thumbs up from the company saying, "Hey, we're doing great and here's your slice of the pie." Third, dividends can be reinvested to buy more shares, creating a snowball effect. It's as if your lemonade stand started selling iced tea, expanding your earnings without you having to lift a finger. This is known as compounding, and it's one of the most powerful forces in the investment world. Lastly, dividends provide a buffer during market downturns. When stock prices fall, dividends can help soften the blow and provide a source of income. So, even when the market is acting like a grumpy bear, dividends can play the role of a comforting blanket. In short, dividends are like a multi-tool in your investment toolbox. They provide income, indicate financial health, can be reinvested for compounding, and offer a safety net during market downturns. So now that you understand the power of dividends, let's dive into how to choose the right dividend ETF for you. So, you're ready to invest in a dividend ETF, but how do you know which one to choose? Well, let's dive right into it. When selecting a dividend ETF, you need to consider a few key factors. First off, the yield. This is the annual dividend payment divided by the price of the ETF. It's essentially the return you get for every dollar you invest. Now, a higher yield might seem attractive, but it's not the be-all and end-all. You see, a high yield could be a sign that the fund is taking on more risk to pump up those returns, so always keep an eye on that yield, but don't let it be your sole guide. Next up, the expense ratio. This is the amount the fund charges you to manage your investment. It's like paying rent for the privilege of living in the house of ETFs. Now, just like rent, you want to keep this as low as possible. A lower expense ratio means more of your money stays invested, which could mean more returns for you in the long run. Then we have the fund's track record. Now, past performance is no guarantee of future results. That's investing 101. But a fund's history can give you a sense of its stability and how it handles market swings. So, look for a fund with a solid history of returns and a management team that's been around the block. Finally, you need to consider your own investment goals and risk tolerance. Are you looking for steady income, or are you willing to take on a bit more risk for the possibility of higher returns? Remember, there's no one-size-fits-all answer here. Your ideal dividend ETF might be someone else's nightmare, and that's okay. And there you have it. These are some of the key factors to consider when choosing a dividend ETF. Your task is to find a balance between these elements that fits your personal investing style and goals. Remember, the goal is to find a dividend ETF that aligns with your investment goals and risk tolerance. And that, my friends, is the art of the deal in the world of dividend ETFs. But wait, before you jump in, it's important to understand the risks associated with dividend ETFs. Picture this, you're on a roller coaster. You're enjoying the ride, the rush, the excitement, but just like a roller coaster, investing in dividend ETFs can be a thrilling ride with a few bumps along the way. Yes, it's true, there are risks involved, and it's crucial to be aware of them before you strap in for the ride. Firstly, let's talk about market volatility. Just like your favorite theme park ride, the stock market has its ups and downs, and with dividend ETFs, you're not immune to these fluctuations. Because ETFs are traded like stocks, Their prices can change rapidly throughout the trading day. This can lead to unexpected losses if the market takes a downturn. Another risk to consider is the potential for dividends to be cut. Now imagine you're on that roller coaster, and suddenly, the ride operator decides to shorten the track. That's what it's like when a company cuts its dividend. Companies may reduce or even eliminate dividends during tough economic times, and when that happens, your dividend income can take a hit. You also need to consider the concentration risk. Some dividend ETFs may focus on a particular sector, which can be risky if that sector underperforms. Think of it like putting all your eggs in one basket. If that basket falls, all your eggs break. Lastly, there's the risk of underperformance. Not all dividend ETFs are created equal. Some may not generate as much income as you'd hope. Just like that roller coaster ride that wasn't as thrilling as you expected, some dividend ETFs may not live up to your income expectations. So while dividend ETFs can be a great investment, they are not without risk. Always do your homework before investing. Because in the end, the best way to enjoy the ride is to be prepared for the bumps along the way. So why consider dividend ETFs? Because they can provide a passive income approach to investing. And by passive, we mean you don't have to sweat out the day-to-day fluctuations of the market. You can kick back, relax, and let your money do the work for you. Sounds like a dream, right? But here's the real kicker. Dividend ETFs can provide a steady stream of income, even during market downturns. Yes, you heard that right. When the market is tumbling down like a house of cards, your dividend ETFs may still be churning out dividends. Now that's what we call a silver lining. Let's put it this way. Think of dividend ETFs as the loyal workforce of your investment portfolio. They're out there on the front lines working tirelessly to generate income for you. And the best part? They don't ask for a vacation, they don't call in sick, and they certainly don't complain about overtime. This can be a particularly good strategy for those who prefer a hands-off investment approach. Maybe you're the type who'd rather spend your time sipping margaritas on a beach than analyzing market trends. Or perhaps you're a busy bee, juggling work, family, and a million other responsibilities. In either case, dividend ETFs can be your financial ally, quietly accumulating wealth on your behalf. But let's not forget, no investment is without risk. While dividend ETFs can provide a steady income, they're not immune to market volatility. So, it's always crucial to do your homework and understand the risks involved. And remember, diversification is your best friend in the world of investing. So, if you're looking for a way to generate income without having to actively manage your investments, dividend ETFs could be a great option for you. Not only can they provide a reliable source of income, but they also allow you to participate in the market's growth, and all this while you can sit back and enjoy the ride. So, ready to give dividend ETFs a shot? So, there you have it. A crash course in dividend ETFs. We've sailed through the surprising facts, understood the power of dividends, identified what makes a good dividend ETF, and even navigated the risks involved. Now, imagine being the captain of your own financial ship, steering towards a passive income approach. With dividend ETFs, it's not just about the destination, but also the journey. The potential benefits are compelling. A steady income stream, a hedge against inflation, and the magic of compounding. But remember, every silver lining has a cloud. The risks, market volatility, interest rate sensitivity, and the ever-present element of the unknown, are part and parcel of the investing landscape. So equip yourself with knowledge, be patient, and make informed decisions. It's not about getting rich quick. It's about making smart, informed decisions that can help you build wealth over time. If you found this video helpful and want to learn more about investing, be sure to subscribe to our channel for more financial advice. Thanks for watching.